So, hi, everybody. This is Kevin Gormley with Leading Edge Financial Planning. And today we're going to talk about the new big, beautiful tax bill, but how it affects pilots. And so, if you're a newer first officer, probably you're going to get to take advantage of some of these things if your spouse is earning tips or overtime. If you're, the child tax credits, you'll get to take the sweeteners there. You get to take the higher salt deductions, which is good if you have a big old house in a state that taxes the heck out of property. So you're probably going to get to take advantage of almost all of these, and your taxes might go down a little. If you're a senior FO, even if you live in a high tax state, your taxes might go down a little bit for federal because, again, of those property tax and income tax and all of that stuff. So it'll be a marginal benefit. If you're a captain, a new captain, probably the same as the senior FO. But if you're a senior captain, this is where basically all of the sweeteners, including the car interest deduction, including even some of the salt tax exclusions, which is huge. Again, if you have $40,000 of salt tax deductions, which is your state and local tax, your property tax, your income tax, that's worth the 10,000 versus the 40 if you're in the 33% tax bracket. Just to make it easy, there is no bracket. But if you were, that would be $10,000 of savings in your federal tax. So as always, we at Leading Edge Financial Planning, we are financial planners, wealth managers. We believe tax planning is the absolute most important thing, not only in the income you're receiving today, but also how you're building your financial wealth going forward. So your wealth gets taxed at the lowest possible bracket and the way that's possible. So if you have any questions, if you're a client of Leading Edge Financial Planning, we absolutely do tax projections. We're happy to do them. We want to do them, especially when these tax changes come, because you're going to hear a ton of rumors on the flight deck in the plane from each other about like, hey, this is going to be of tremendous benefit. Go ahead and buy a car for one of your children because you can deduct all the interest. That's true if the child owns it. But if somebody with more than a certain amount of income, phase outs are really the hint here. If you make too much income, a lot of these sweeteners are not going to be sweet. You're going to be very disappointed. So anyway, let's jump into the meat and potatoes of the tax bill and how it affects pilots. And so we've been going through it. We've read all the articles that you've probably read on all the different details. And we think that's great that all of those articles have been read. But when it comes to pilots, a very distinct group of people that make certain incomes, and we know the incomes. So we can look at this kind of as a newer first officer, what might be in it for you, for someone that's, been flying for a while with a major and making a goodly amount of income. And then for captains, there's really some critical items in here for captains as far as trying to keep your income in certain ranges, if you can. Again, we don't want to do everything to just save on taxes. That's called the tax tail wagging the dog. We don't want the tail to wag the dog. But at the same time, we also do not want to not take advantage of opportunities. So I'm going to go through a slide deck. You can speed this up, slow it down. So we're going to go through some of the overviews of the big, beautiful bill, the legislation, the individual tax changes that are really most important for our pilot group, a few tax provisions, business tax provisions, because sometimes y'all start other businesses and we want to at least mention some of the items that you can do, some of the sweeteners. There are some new and modified deductions. The word phase out is, to me, that I hate saying phase out because that usually means you ain't getting it. If it phases out, this is available, but you make too much. Therefore, never mind. And so it can be very painful. The energy and green tax credit, again, there's a phase out there if you want to buy a new car before September. So just a little actionable intelligence there. International and estate tax changes, not a lot there unless you're sending money to people overseas and you're not a citizen. And so let's just jump in. A lot of these things we will not cover because our team has not felt like they're that important. So this is the big one, and it's not going to feel that great. And what I mean by that is the taxes are not going to get worse in 2026. Our big fear is that the 2017 tax cuts and Jobs Act were going to get sunsetted. We talked a lot about the sunset, and then everything would get worse going forward. Well, never mind about it getting worse. So it's not going to get worse than the last few years. It's good news, but it does not feel like great news. here's the good news. So this was in 2024, and they were looking at the 2026 tax brackets, and they were going to go back to instead of 10, 12, and 22, 10, 15, and 25. And you could see you would go through all those brackets. So there's a lot of goodness and just nothing changing, but it sure doesn't feel that great. So the brackets are going to stay the same. And here's the brackets for single and for married if you want to stop the slide or stop the presentation here. Now let's talk about phase outs. Phase outs are usually not your friend because the only time you hear about a phase out is when you made too much money, and some might consider you to be too rich. We know that there's a difference between high income and high net worth. But anyway, so first of all, the SALT cap, deduction cap, if you're in Tennessee, Florida, New Hampshire, Nevada, as well as a few others, you don't even care about the SALT deduction, so don't pay attention. But if you're a captain and you're living in a state that has an income tax, absolutely, this would be really important. The phase outs start at 500,000. And at 600,000, the $40,000 SALT deduction that's brand new and great, poof, it's gone. And it comes down from 40 down to 10 from 500 to 600. Again, it must be nice. People say it must be nice for you to make more than 500,000 and have this problem, but you've worked hard for many years and it still is a problem. So the senior deduction. So we heard a lot about Social Security not getting taxed anymore. That turned out that did not make it into the final bill. I didn't see anything about Social Security. I heard when the bill was passed that, helping seniors and all this, but really what it is that if you're over 65, you used to get a little bonus on your standard deduction. The little bonus now goes up to 6,000 from whatever it was. Most of the time, I think it was 2,000 per person. So again, if you're itemizing, probably wouldn't even help. But most of our seniors that we work with are not itemizing, but some are. So anyway, this was the new sweetener that was put into it. Again, the phase outs, $175,000 in income and $250,000 of AGI for married filing jointly. Our tax system mostly taxes income, has very little to do with how rich or wealthy someone is. The Section 179 expensing is important if you run a business. The bonus depreciation, the phase outs are not for mere mortals. They're really for big companies. So not much to worry about there. The QBI deduction, if the spouse has another job in her own business or his own business, then this could really be something to look at. But basically, you save 20% on all your tax when you run a business. Tip income deduction. So you've heard about the tip and the overtime. Again, these are really good, I think, for middle class and for other lower income people. But they do phase out at a 150 single, 300 married filing jointly. The car interest deduction, a lot of people were extremely excited. They're like, yes, I'm going to get to save on my car interest. I'm going to have $10,000 of interest. I'll get to deduct it all on my taxes. Not so fast. If you make more than 100,000, 200,000 married, you'll lose that ability to deduct. There is also a new cap on the highest tax bracket. So the highest tax bracket is 37%. There's a certain amount of deductions and that's all you get. AMT, no one knows what it is. And thank God, you probably still won't know what it is. It's $500 or $1 million for married filing jointly. So usually that doesn't come into play. Now, this is pretty good news. The standard deduction amount, if you do not itemize, has gone up. It's gone up to $31,500 for married filing jointly. So if you do nothing, you still get this. Just being alive at the end of the year, you get this deduction. There's also some charitable deduction on top of this. I think it's $1,000 to $2,000. Now, the SALT deduction. Now, we really see this as a big issue for clients that are living in California, New York, Illinois, even New Jersey. My former home state of New Jersey is taxing people at 10%. And property tax and all the rest of this is just so high. So if you're a pilot and you're maybe middle income in California, I'm kind of joking, but let's say you made $510,000. You would lose part of that $40,000 deduction, and it goes down by 30% until it's totally gone. Once you get over 600,000, you're back down to the $10,000 SALT deduction. Now, this only is available for a number of years, but who cares? I mean, probably next administration probably will get new tax changes. Nothing is ever permanent in the world of tax. So captains in states, be aware. I meant to say captains in high tax states, be aware. Again, goes from 40,000, which is some tremendous relief, even for people in Georgia and some of these other states that didn't used to be high tax states, but now the property taxes are getting high. So anyway, this is just something to be aware. If you're going to make more than $500,000, some people would say congratulations, but also we just should do some tax planning. These are just a few things. If you have a side business and you want to take 100% expense on that business, you can. It's called bonus. Who doesn't like a bonus? And so anyway, and then the QBI, that's the 20% deduction on your business. Again, it's not usually rich people that have these businesses, but I guess it is possible that rich people would get that too. Qualified opportunity zones. We've not been huge fans of this, not because we don't want to save taxes, but you've basically had to sign up with a private company to be able to invest in opportunity zones, but it's back and it's a way to avoid large capital gain windfalls. So we have tip income. And again, you can save, I think it's $25,000, if I'm not mistaken, on tip and overtime. Overtime might be lower, but again, we do have those carve outs. And then the car loan interest deduction. This is really great if your child is maybe a 22, 24, 26-year-old young person and they can buy a car in their name and deduct the interest. Of course, they have to be on their own insurance then, but that is a possibility, an idea for many of our pilot families. Charitable deductions. Now, when you make a little bit of deduction, you get nothing. Except if you're a standard deduction, you can take $1,000 or $2,000 for joint filers. So that's all there is there. All the energy and green tax credits, if you like them, most of them are gone. So anyway, if you still want to buy a car, and again, you're under the phase outs, I think it's 300,000, but somebody will correct me if I'm wrong. All the other ones are pretty much gone. So I do have family overseas, Dominican Republic. My wife is Dominican, and so this remittance tax is a big deal. People are upset. You send money, you got to also pay 1% tax. It was going to be 3.5, so 1% sounds a lot better than 3.5. All you need to know about the estate tax is it didn't get cut in half. It actually got raised. So now you and your spouse can leave $30 million, federally speaking, to your family without paying any estate. And you can also give away that amount of money during your lives. Now, some states still have estate and inheritance tax, and be aware of that. So as we come to the end here, the mortgage interest deduction is still at $750. The good news here is that you can also have mortgage insurance premiums. Like some of you, if you don't know what that means, some of you might have children that are 25, 30 years of age. They're buying their first house and they can't put 20% down. So they have these mortgage insurance premiums. And they were told for years that, hey, you can't do anything with that. You can't deduct it. Well, now the bill says for certain mortgage insurance premiums, I'm not sure about the certain yet, but we'll definitely learn what that is. Home equity line interest disallowance. We think if you still buy, build, or improve that you can still deduct it. But we're waiting for, more research on this, but we think that's the case. So yeah, your spaceport. I thought that was just pretty funny. So anyway, that's why I put it in the slide deck. You can deduct your spaceport just as if it was an airport. A few other things here. So this to me is one of the most interesting parts for pilots. This is a foot stomper. We've had so many times where pilots have asked us, well, hey, I got this 529 for my son, for my daughter. They're going to flight school. They're going to go to the flight school that costs $100,000 in 9 months. Can we use the 529 money? And we always said, no, I'm sorry. Well, now I think the answer might be yes, because it's been broadened tremendously. Even for myself, doing my CPA, CE credit every year, I've always had to pay for that out of my pocket. 529 would not be helpful there. So there's going to be a lot of strategy to come, I think, with 529s. There's also a lot of tremendous benefit for 529s with adult children where if you would have gone back 15 years ago and put money in the 529, you could change it to Roth. So, I'm just starting to think everybody should set up a 529. Speaking of everyone should set up, if people are having babies the next number of years, there will be a Trump account set up and more to come on that. All I know is that that's super interesting. If you have children or grandchildren that are going to be having babies, they might want to have them the next, I think it's 3 years, maybe 4 years, but I don't have the exact on that. So I just wanted to finalize some of the thoughts here. If you're a first officer and you started your career, you're early in your career, most of the phase outs are not going to affect you. If you're a senior FO, then many of the phase outs will affect you. So that's just something to be aware of. Now, the big phase out to me is the phase out with assault deduction. And the reason that's such a big phase out for captains is that it can save a lot of tax. I mean, if you could have an extra $30,000 of savings in income, that's a $10,000 savings on your federal income tax if you were in the 33% tax bracket. So that's a heck of a lot of difference. So the child tax credits have gone up a little bit from 2000. I think it's to 2,200, but somebody can correct me if I'm wrong there. But again, the 400 to 500,000 range, married filing jointly, and head of household is less. That's when those credits start going away. And again, it's all about the marginal tax rate and the marginal tax that people are paying. The bad news is, and maybe I should have just said this first, is that you're not going to see a lot of changes for the most part. If you're a senior FO or if you're a newer captain and you're not making over $400,000 to $500,000, you're not going to see a lot of changes in your tax. So that's disappointing.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.